Have you looked at the housing market lately and felt like you're getting two completely different stories? On one hand, you see headlines about a price crash in places like Florida or on the West Coast. On the other, you hear about bidding wars and rising prices in the Midwest and the Northeast. This isn't just a feeling, it's a statistical fact. Let's look at the data for the largest 300 metro areas in the United States over the past 12 months. What we see is a sharp regional divide. The map showing price declines is heavily concentrated in the South. We see significant red bubbles, particularly in Florida and across the West Coast. These are the markets that saw the most explosive growth during the pandemic and are now experiencing a significant correction. But then, we look at the map of price gains. It's a sea of blue, dominated by the Midwest and the Northeast. In fact, of those 300 major markets, home prices have actually gone up in 195 of them. Prices have only gone down in 105. This brings us to the national average, the number that causes so much confusion. When you blend all this conflicting data together, national home prices are up 1.7% over the past 12 months. Now, if you're in one of those red markets, you're probably yelling at the screen. You're saying, "My area is down 10%. And you are absolutely correct. But you have to understand the "so what" factor. For the national average to be positive, it means another market somewhere else is up by 11.7% or more just to balance out your decline. This is the most divided housing market we have seen in decades. It's not one single market, but a patchwork of dozens of local stories. So the first question we have to answer is, why isn't the whole thing coming down? And more importantly, what happens next? I'm going to give you my prediction for 2026 and beyond. This prediction isn't based on a gut feeling. It's based on economic forces that are already in motion. But before we can look forward, we have to understand the single most important variable in this entire equation. I'm talking about the cost of borrowing money. We need to look at mortgage interest rates. You've probably noticed they've started to fall. We need to understand why they are falling, and more importantly, how much lower they are about to go. Because the answer reveals a plan that has already been set in motion. Let's break down what's happening with mortgage rates. Right now, the average interest rate on a 30-year fixed mortgage is hovering near 6%. Now, to be clear, that is nowhere near the 3% or even sub-3% rates that many people were lucky enough to lock in 3 to 4 years ago. But it is a massive relief compared to when rates were flirting with 8% back in late 2023. As we've moved through 2025, the clear trend has been downward. The obvious question is why. The simple answer is that the Federal Reserve, which is the central bank of the United States, has been cutting its own interest rates. They're doing this because inflation is not raging hot, at least not relatively speaking compared to the spikes we saw 2 or 3 years ago. But this is where most financial news stops. They say, the Fed cut rates, so mortgage rates went down. That is a dangerously simple explanation. If you want to understand what happens next, you need to know how this system actually works. The Federal Reserve does not control mortgage interest rates. Let me repeat that. The Federal Reserve does not set the 30-year fixed mortgage rate. Here is the mechanism you need to understand. When the Federal Reserve cuts its key rate, the Fed funds rate, it directly affects short-term government debt. Think of it as the overnight lending rate between banks. Mortgage rates, however, are correlated to something entirely different. They are tied to the interest rate or yield on 10-year government debt, also known as the 10-year Treasury. When the Federal Reserve cuts its short-term rate, it helps to lower mortgage rates. Somewhat. It signals to the market that the cost of money is getting cheaper. This is why we are seeing a moderate decline in rates, not a plummet. We are only talking about interest rate cuts. This is just one tool in the Federal Reserve's toolbox. They have another, far more powerful tool designed to force mortgage rates dramatically lower, and they are getting ready to use it. My expectation is that the Federal Reserve will be ending their monetary tightening cycle very soon. Word on the street is that it may be even this month. Now, it's my expectation that the Federal Reserve will not only continue cutting interest rates, but they're going to start their quantitative easing cycle in 2026. Quantitative easing is that other tool I was referring to. If you're not familiar with it, Quantitative easing is the polite academic term for the Federal Reserve creating new money out of thin air to buy financial assets. This is not a small operation. When they do their easing, they will buy hundreds of billions or even trillions of dollars worth of assets. These assets are primarily government debt, known as treasuries, and just as importantly, mortgage-backed securities, or MBS. Buying MBS directly forces mortgage rates down. So, a good question is, how much money will they print, and when exactly is it going to start? Let's be blunt. Each easing cycle, each money printing cycle, gets worse and larger than the last. The system becomes dependent on this liquidity, and they need to print more and more money just to keep the system afloat. So, when will this happen? It will happen when something big needs to be bailed out. The economic data the government reports might look rosy, but the underlying system is fragile. Who will need the bailout? Will it be the banks again, struggling with bad loans? Will it be commercial real estate, which is facing a historic downturn? Will it be the stock market after a sharp decline? Take your pick. Given the stress in the system, it could be the first quarter of 2026, or it could be the third quarter. I would be very surprised if they make it to the fourth quarter without starting a heavy easing program. Okay, so what does all of this mean for you in plain English? It means that mortgage interest rates are set to continue their journey down. But this is the critical part. When mortgage interest rates drop meaningfully, when we see them fall significantly from where they are today, that is going to be your opportunity. That will be the best time to either refinance your existing mortgage or to lock in a rate on a new home purchase. You are going to have a specific window of time to capitalize on this situation. I expect that window of time to be a few months, not a few years. In other words, mortgage interest rates will eventually bottom out. Of course, nobody can perfectly time the absolute bottom, but you will have a period of months to take action. I'm telling you this now so you can be prepared. Just don't dilly-dally for too long. Why am I saying this with such urgency? I'm saying this because the Federal Reserve's balance sheet expansion, their money printing, has a guaranteed side effect. It's not a surprise to anyone. That side effect is inflation. Yes, inflation will follow all of this money printing, but it's important to know that inflation lags. It takes time for that new money to filter through the economy and start pushing up prices. Once that inflation starts catching up, when it starts spiking up again, what do you think happens to mortgage interest rates? They are going to shoot right back up. This is because the 10-year Treasury yield and the 30-year Treasury yield are highly sensitive to inflation. When inflation is raging again, investors demand a higher interest rate on long-term debt to protect their money, and mortgage rates will follow. So, let's be very clear about the strategy. I am mainly talking to the people who have mortgage interest rates locked in at 6% to 7% or even higher. For those people, a refinance should be a top priority. You have to strike when you get the opportunity. If you are one of the fortunate ones who already locked in a mortgage interest rate of around 3%, or maybe even sub 3%, then you don't have to worry about any of this. You've already won this part of the game. Now, let's circle back to the original question. Home prices. What does this massive money printing operation mean for the price of your home? It's going to be the exact same story. I just want you to think about this practically and logically. The Federal Reserve is going to be cutting interest rates and printing trillions of dollars. This money has to go somewhere. It will cause more inflation. I'm talking about inflation in the prices of everything. Your food, your utilities, and yes, your home. Home prices are not going to be immune to this. This is the central economic force you need to watch. So why would home prices crash if the Federal Reserve is about to blast on the money printers and create trillions of dollars? You already know the answer. Inflation is coming and housing will be one of its primary targets. You can even look at this headline from 2022. You should know that home prices hit another all-time high this year, in 2025. Now this is the part of the video where I get the most pushback. People say, if home prices keep going up, then nobody will be able to afford a home. Therefore, the argument goes, home prices can't continue to go up. My response to that is, seriously, is that what you truly believe? Have you seen home prices in California? Have you looked at the cost of housing in New York City? If it can happen there, I promise you, it can happen in your hometown too. The situation can always get worse. So, to answer your question, who is going to be able to afford a home? I think the answer is easy. Institutional investors. People like BlackRock. They are going to be your new landlord. Listen, I'm telling you, if you are in a position to buy a home now, I would strongly consider it. The housing situation in this country is just going to get worse, not better. Now, let's talk about the other big crash narrative, foreclosures. It is no surprise that foreclosure activity is going up. It is rough out there. I know you've been fed the propaganda that the labor market is solid, that unemployment is near record lows, that the economy is booming and we are in a golden age. I am deeply skeptical of those numbers. I believe that income has not been keeping up with real inflation. I believe the labor market is far worse than what the government has been reporting. I believe that we are already in a recession, and that's why I'm not surprised at all that we're seeing this foreclosure activity ticking up. However, if you are expecting foreclosures to trigger the next housing market crash, just like the crash did in 2008, I really want you to look at this data. Okay, so, sure, foreclosures are going up, but they are nowhere close to where we were during the last housing market crash. Just hear me out. We are not even at the level of foreclosures that we saw in 2005, which was before the crash even started. If you are waiting for foreclosures to spike so that home prices crash, you are going to be waiting for a very long while. If you look at the last cycle, from this level of foreclosures today to the peak of foreclosures, that was about 5 years of waiting. But did you know that's just when foreclosures peaked? Home prices didn't actually bottom out until 2012 in the last housing market crash. That means you may be waiting another 8 to 9 years for the bottom of a housing market crash, if it even happens that way again. If you wait 8 to 9 years, can you even imagine how much home prices are going to go up by then, after the Federal Reserve prints trillions of new dollars? They will probably still be much higher after the crash than they are right now. The time to worry is when foreclosures have already massively spiked up. That is the warning sign that home prices are about to crash. Maybe we'll get there in 4 years. Maybe we'll get there in 7 years. Who knows? But if you're going to use foreclosures to judge when the housing market bottom is going to take place, then this data should be helpful to you. I'm just giving you the facts, which is why I am saying that I believe if you can buy a home right now, then I would buy a home. That's just my opinion. And one thing that really bothers me is when people say, well, if you buy a home, then you lose because you have to pay property taxes and all these expenses. I just want to point out the fact that when you rent a home, if the property taxes go up, your landlord just passes that cost on to you. I hope people understand that. Listen, I just want to say that buying a home to live in, it's not really an investment. At least, that's my perspective. It's not a get-rich-quick scheme. It's about owning your own assets to protect yourself from inflation. It is very straightforward. This reminds me of one of my friends who was renting during the pandemic. His landlord raised his rent by 40%. Just overnight, when his lease expired. They said that's the new rate, you can accept it. Otherwise, we have other renters that are ready to take your place. So, there's your housing market update. I just want to end by saying this. I wish for affordable housing. I wish for a solid labor market and for a booming economy. But I just don't expect that for 2026. I'm looking at the situation. I'm looking at the data. And honestly, I just don't see it. That's just my opinion. You can let me know what you think.